Hey there, welcome back to the channel. Today we're diving into something every homeowner in Canada should know, the 4-year rule for principal residences. Whether you're selling your home or just planning for the future, understanding this rule could save you from paying a big chunk of taxes. So let's break it down. First, let's start with the basics. Your principal residence is essentially the home where you and your family live most of the time. It could be a house, a condo, even a cottage. What matters is that you've lived there for a certain part of the year and have designated it as your principal residence when filing your taxes. Now, what is the famous 4-year rule? It's a rule that allows you to designate a home as your principal residence even if you weren't physically living there for up to 4 years. Sounds great, right? But there's a catch. It only applies in specific situations. This rule is particularly useful if you need to move away for work or if you're transferred to another city but plan to move back. Here's where the rule comes in handy. Even if you're not living in your home for up to 4 years, you can still claim it as your principal residence, avoiding capital gains tax when you sell it. But what if you decide to convert your principal residence into an income-producing property, such as a rental or a business? Normally, when you change the use of your home, you would have to report a capital gain based on the increase in the property's value. But there's a special election you can make to avoid that. If you elect not to be considered as having changed the use of property, you don't have to report any capital gain at the time of conversion. However, there are a few key things to keep in mind. One, you can't claim capital cost allowance on the property. And two, you still need to report any income from the property, minus any applicable expenses for tax purposes. While this election is in effect, you can continue to designate your property as your principal residence for up to 4 years, even if you're not living in it. But to do this, you need to meet a few conditions. You can't designate any other property as your principal residence during this time, and you must be a resident or deemed resident of Canada for tax purposes. Now, if you meet certain conditions, you can actually extend this 4-year limit indefinitely. To qualify for this extension, you need to 1, live away from your principal residence because your employer or your partner's employer requires you to relocate. Neither you nor your spouse or common law partner can be related to the employer. 2, you return to your original home while still working for the same employer, or by the end of the year following the year in which your employment ends. Alternatively, this extension applies if you pass away while still employed. Finally, your original home has to be at least 40 kilometers farther from your temporary residence than you or your spouse's new place of employment. To file this election, it must be submitted under subsections 45(1), 45(2), and 45(3) of the Income Tax Act. This election needs to be filed separately from your tax return. It is not automatically included. Instead, you must manually submit a signed letter to the CRA. For more information, please visit the CRA website. The link is provided in the description below. This manual submission ensures you take the proper steps to defer capital gains while still claiming the principal residence exemption under the 4-year rule. That's all for today's tutorial. Thanks for watching, and if you have any questions, please leave them in the comments below. To learn more, visit our website and follow us on social media.